I'm familiar with passive versus active losses that you can write off. How does that work?
Active losses, in a general sense, you can write off in full. Passive losses are limited as far as what you can write off. A lot of times it's nothing. For rental real estate, there's a specific exception to that. So rental real estate is by default is considered a passive activity. It's a special category of passive activity called active participation in rental real estate. You can get up to $25,000 in deductible losses on your tax return when you have rental real estate activity as opposed to other types of passive investments. That itself can be pretty limited. As soon as your other income goes over 100,000, you start to lose some of that 25,000. Once you cross 150,000, it's gone. So you could have rental real estate, have losses in theory, allowed to take some of those losses, but because your income is too high, and that's a relatively low bar, you don't get any of those losses. What happens to them? They don't disappear. They roll over. They are counted as another opportunity to take some losses in the next year, and they'll just keep rolling over forever. They never expire. So if you hit a situation where you either have, say, income from that activity or other passive activities, those losses can come forward and reduce future taxable income, either rentals or other passive activity. And that can happen if your income goes down, or again, if you're just generating now some passive income, those losses automatically come in full to offset that. And then when you sell, you get all the losses against the sale in full. That whole process disappears upon sale, and all the losses kind of free up against the gain of the sale and against other rental real estate that year too. So that passive activity rules, again, pretty complicated, very unique to everybody's situation. But if you're a real estate investor, it's something you should get familiar with and understand how it's going to impact you.